Well, here we are. The US government has officially shut down, but do we care? Is it a storm in a teacup? And we ask those questions in today's trade-off. But with a shutdown in play, do the Fed now have the lack of visibility to make a call in the October FOMC meeting? Perhaps even the December FOMC meeting? We're still waiting to hear whether or not we get the payrolls data coming through. But at the moment, we're seeing a little bit of weakness coming through in the US dollar. Treasury's a little bit bid after the ADP payrolls number. But equity markets fly high. We've got the S&P and the NASDAQ and the Dow looking like they might want to push to new all-time highs as healthcare stocks absolutely ripped. Certainly if you have a look at daily chart of Eli Lilly, it's on beast mode at the moment. Tesla's flying high into delivery numbers, and Nvidia breaks out to new all-time highs as well. The equity market is flying high, and will it turn back the longer this shutdown continues to go on for? We also have a look at the gold trade, which of course has been front and centre and on everyone's trading radar, as is silver. That comes into big levels. Obviously a lot going on. Volatility stays low, but big levels are being tested, and we break them all down in today's trade-off. Hi, I'm Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics. And we'll be discussing all the factors in this crazy world of markets, all the big situations that we're seeing in terms of the daily charts, the longer-term pictures, and also the trading ideas and the directional trades that we like and have on the radar. So, Mr. Blake Morrow, would you please come into the show? I am a broken man at the moment. I had a couple of days off, and I took my children, my 3 children, my wife, she organised it, to go to the Melbourne show, which is like basically sort of a showground with rides and bits and pieces run by sort of carny folk. And my 10-year-old took me on this sort of thing called the Joker, which is like a big pendulum, which is about 150 feet high and sort of spins around. And I realised halfway through that I'm 45 years old and shouldn't be doing these sort of things. And sort of I've got some pictures which I'll show you, but I'm sort of broken, and I was just like, get me off this thing. And I sort of came back and I sort of landed on the floor, and my son's like, oh, yeah, it was amazing. And I think it sort of changed me for the day. I was sort of just a different person after that point. I've got pictures of me just going like that. And you realise that, maybe when I was 25, I would have enjoyed that. But I've got that motion sickness, when you've been on a boat for 2 days and you're sort of sitting there and you can still feel it. And you realise at 45 that, your time is done. You shouldn't be doing this. A good father, because, I put up with it. But Jesus, I feel broken, man. So you might have to help me out through the show today.
You got it, buddy. Hats off to you for being such a great dad, though.
Yeah, we had this. There was this one called The Haunted House, right? And we're walking through it, and my 7-year-old says, Dad, I want to go into the haunted house. I said, it might be a bit too much for you, mate. And he goes, No, I can do it. Do you dare me? And I said, yeah, look, if you come out, I'll give you whatever ice cream you want. And so he goes into the haunted house. There's a zombie guy at the front, and he's like beckoning people in. He's like, and just thick Irish accent, come in. You're going to die. You're going to put up with this. And my son's like, I'll do it. And he walks in there, and about 2 minutes later, I'm at the exit, and he's come running out the exit screaming as this tiny little man comes out with a chainsaw after him. And I was like, oh, shit, I didn't think it was going to be that bad. And obviously he's shaking, he's unconsolable. And he's like, well, maybe that was, I'm a bad dad there, that was too much. And I sort of console him. I said, it's going to be okay, I'll give you that ice cream. And he's like, all right. And he walks straight up to the zombie at the front, and he goes, Arr! And I was like, where'd you learn to do that? And I was like, good response. But it was kind of one of those, I'm not going to forget that situation. He comes running out this haunted house with a guy with a chainsaw. Anyway, enough about my ramblings.
Proud Papa moment.
Enough of my ramblings. Let's go into markets. So go to Topical Thunder. Right, government shutdown, taking it away from the Melbourne show and going into something that is a bit more real. Obviously, not a funny story if you're going to get furloughed and your job's going to sort of be temporarily taken off. But everyone's doing the numbers now. It's front page stuff. But equity markets don't really care too much at this stage. The sort of general feeling here is that this does have a natural handbrake. Things like military personnel, and they're not going to get paid. If that happens, that could be bad. Some of the payments to food stamps to lower income earners, I think it could be a big political hot potato. But I think the sort of general consensus here is that the longer this goes on for, perhaps it could become an equity story. It could perpetuate some selling in the dollar. We've got the debt ceiling out the way, so that's not going to be. There's no sovereign rating issue around this. I think we've heard today that for every week that the government is shut down, we're going to see about $15 billion lost on GDP. People are doing the numbers in 2018, 2019, which was the second government shutdown under Trump's first tenure. And that lasted, 34 days, erased 11 billion of GDP in total. After the paybacks that people were given back, I think about 3 billion was ultimately lost. A little bit of buying in treasuries in that episode. But at the moment, the market really doesn't care too much. I think probably the big thing that we talked about last week was the idea that we may not get the payrolls. There's a chance we could if we can see it rectified and the government reopens soon this week. But at the moment, a little bit of dollar selling, but I think that's probably more down to the ADP payrolls number that was poor. But I just don't see this being a major market story at this stage. It's a lot of headline risk playing through and shows how dysfunctional the situation is. I think probably the big thing for me, Blake, here is a Trump administration is saying that we're going to see some non-essential workers being permanently laid off from this situation, playing hardball, and that could muddy the water and make things a little bit more aggressive. But people see that as a negotiating tactic at this stage. How are you reading it? Are you worried? Do you care too much?
Well, at this point, I'm with the market. I don't really care too much. However, I do think that this could end up being a little bit more of a storm in a teacup, as you so eloquently put it. And the permanently firing of some government employees, I think, is a realism that the market is just coming to grips with. There's some articles about it today, but if some of you might have missed some headlines a couple of weeks back, where the Trump administration was actually looking and looking for different branches to give them lists of who would be permanently fired. And so they know who they're targeting, and I think they're using this as an opportunity to kind of cut the spending a little bit at the same time and thinning out government services a bit. So I see it as a threat, and I do think that the market is just aimlessly hitting new all-time highs, climbing the wall of worry, assuming that everything is going to be okay. But we'll have to see if this becomes prolonged. I do believe that we get a couple 2-3 weeks into this, and the markets are going to not be so kind.
We know. I mean, everyone knows how this ends, doesn't it? But ultimately, I think that the permanent layoffs. We've got some some voluntary layoffs, which are going to come and be seen in the next payrolls data and bits and pieces. But it's the permanent ones, which obviously Trump will lay off in sort of Democrat leaning roles or things that have been created under prior Democrat policies. Is that just a firm ball negotiating tactic to say, look, Democrats, if you don't get this sorted out and go to our terms, then there's going to be more people losing their job and it's going to be your fault, and that's a pretty hardball tactic that he could be doing. So, but I think it's probably a big unknown or known unknown that could be something more of a market situation further down the line.
I agree, and I think it is something that we need to prepare for, and that's why I wanted to take us to our next subject matter, which is hedging. Last week, Chris, you talked about how cheap volatility was, and we had a discussion about there's some VIX products that you could buy, like UVXY, I believe is what it one
VIX,
of them.
VIX ETF, all those,
all those really ultra ETFs. You could do something like that. It's relatively inexpensive, as long as you don't have to carry it too long. But I wanted to talk a little bit about currency hedges because there's if you take a long-term VIX chart, which I'm not going to show you right now, but you overlay the dollar Canadian, and you'll notice that the big moves in the dollar Canadian over the years have really corresponded with almost precisely with big spikes in VIX. So if you do think that there is going to be some risk aversion coming up, selling Canadian dollars is not a bad idea. And also, if you've watched price action of the Canadian dollar has looked very weak as of late. Another one would be like the dollar MEX. The dollar MEX, or any emerging market currency, but the dollar MEX I think is one that is worth noticing because it is sitting so close to its long-term 618 golden Fibonacci level. But those are some FX ways to hedge. Now, a lot of people, Chris, normally, I say normally, you think back like the last 20 years, people would say, okay, if we're going to get risk aversion, I'm going to buy yen. Yeah. I don't know if the yen is the risk off currency to buy these days, especially with the political drama that's surrounding the LDP. What are your thoughts on what other hedging vehicles could be used, FX or non-FX related, that could really hedge against a market should we have some disruptions over the next couple of weeks? Yeah,
I mean, it's a great question. Yeah, I mean, if the VIX starts creeping up to above 20% as people start going, oh, this is, a bad situation. But I just don't see that happening because, there could be some impact on growth, but then that gets paid back further down the line. And the US is in a very strong growth position in Q3 anyway, and going into Q4. I mean, we're sort of toying with the idea of that Q3 GDP is going to be around sort of 3.6%, which, they probably can afford to lose a little bit. And, we're going to see the Fed cut rates in October, maybe December again as well. So it's not a terrible situation for them to be in. But to answer your question, I mean, I think people have been looking at gold. I mean, that's the obvious one. People have been looking at running the sort of regression and looking at most sensitivities in prior shutdowns and how that's worked. Gold's been, the standout. I think in the last episode, which, as I say, went for 35 days, I think was one of the biggest shutdowns or longest shutdowns we've seen. And that took about 0.3% off US GDP. So that gives you a pretty good understanding about how this all works. And the 10-year Treasury on the long end, duration rallied 25 basis points. So we saw yields down a little bit. So, you could see yields down a little bit. You may see, we'll see what happens with the curve. But, Treasury's down a little bit. Maybe duration works, and maybe the dollar falls. But I think dollar yen actually looks like a good short at the moment. The LDP election on the weekend, I think people have got pretty comfortable with it. People have been actually buying dollar yen vol. 1 week vols were up about 2.5 vols overnight. So that's quite an interesting one there as well. Risk reversals have started coming up, so people have been paying up for downside in that pair. So I think the yen, I get your point, and I completely agree that the yen hasn't been a brilliant safe haven in FX. But then nothing really has, the Swiss franc perhaps, but that, if you want to go into that, that's all about the European issues. But I think the yen looks all right at the moment. And I think maybe this is I got pretty excited last week about dollar yen, and it got up to 150, and it's rolled back into the prior range. So I think this probably goes lower in the short term. We'll have to see. I've got a chart on that at the moment. But I think gold's been the standout, but that's looking nosebleed rich right now. You wouldn't be chasing it at this level, in my opinion.
Yeah, it sure does.
Well, I want to go into the equity side of things, Blake, because I've got a chart of Tesla in a moment. What's that? That closed up 33% in September, one of the best months we've seen for years, and a bit of short covering, I suppose. But obviously, people are getting pretty excited about the numbers that we're going to see tonight. In terms of delivery numbers, and are we going to see a sell the fact? Talk about that in a second. Nvidia's broken out to all-time highs. I think Advanced Micro looks like it's ready to make a squeeze to the top side. Healthcare, I mean, it's just been absolutely ripping because we've seen the deal between the Trump administration and Pfizer as well around drug prices. That removes a bit of the uncertainty around the generic drug or the drug pricing, which, Eli Lilly's just gone nuts. And, some of these healthcare stocks have really, really outperformed. And that's been a really good place to be. People have been covering shorts and adding to that. But NASDAQ looks like it wants to break out. You go into Hong Kong as well. I mean, we're sort of talking about US equities, but Alibaba and Tencent in the AI space has been absolutely ripping. Hang Seng looks like he wants to break to new all-time highs. So at the moment, I still like, buying any kind of pullbacks. I think it's the trade, and I just want to continue to stay long. I don't think there's anything that really massively derails in the short term as we go into the earnings season, starting, I think, it's on the 14th of October, where we're expecting aggregate revenue growth about nearly 8%, and earnings have been revised higher into this earnings season. So it's you've still got those tailwinds from rate cuts and all those factors playing through. It still looks like the equity story is a good one.
It does, and I mean, we call it the wall of worry, don't we, Chris? I mean, here we are.
Oh, we do.
Government shuts down. S&P at new all-time highs. I mean, what's stopping this market? I don't know what sticks to Teflon and what sticks to this market. I don't know if there, but you know how it is, Chris. It's always the black swan event, and I know black swan is a overused and very generic term, but it's always something that we don't see, and I don't know, if I could see it or you could see it, then it wouldn't be a black swan. But right now, the only big fears that we have is maybe valuations And given the fact that we are, shutting down the government and maybe people get a little bit nervous at these high, levels in equities. But until you start to see technically, lower lows and lower highs, I don't think there's any reason to be worried about equities right now.
Well, the thing is that, stay long, hedge yourself through gold or whatever. But what you've got now is a situation where you need something to actually break break that the camel's back sort of thing. But right now you've got high valuations, but valuations have been high and they've been a terrible precursor of where equities are going to go. But you've got high equity valuations, low equity risk premium. You saw the Oracle, was it 15, 18 billion bond auction or capital raising the other day, bond raising the other day, corporate bond massively went well. I mean, that's an issue. Then you've got, the word AI bubble seems to be coming up more and more. You've got record amounts of crowding coming through, so positioning is very squeezed. And if you go into the volatility targeting funds, the insurance pension companies that target a level of standard deviation, they've gone through increasing that allocation about $2 billion a day of buying, and now they're at very high leverage rates. So positioning is very rich, from long only, from leverage community, CTAs and max long, and you've got, there's so much frothy conditions, but you need something to break it. You need something that's going to derail that process, and I don't know what that is, but you've got all these factors that when it comes, it could be quite prolific. But I'm not going to get time now. I still think that equities can go higher short term.
Yeah, well, and that brings us to our last topic. Maybe the only thing that could really derail the market would be the non-farm payroll. Oh, I'm sorry, we're not getting non-farm payroll this week.
We might because we could still get it. We could still get it.
It'd be a really close call, even if the government, something was signed tomorrow, a stopgap bill that was signed tomorrow. I don't know if the BLS would be able to get its ducks in a row to give us a release. And we saw today. Well, let's go back to tomorrow. So tomorrow is Thursday in the United States. Weekly unemployment claims. We're not going to get that data. I believe the Challenger numbers we'll get because that's private. And then on Friday, we're not going to get the jobs report. So now the market's going to focus on the ISM. Now we got the ISM manufacturing data today, but since the U.S. is a services economy, everybody focuses on the ISM services data. Now, typically, every once in a while we get the data before the jobs report. And if we get the data before the jobs report, everybody focuses on the employment component of the ISM services number. But this week, we were supposed to get it after the jobs report. But that means that at 10 a.m. Eastern on Friday, 10 a.m. Eastern, and that's going to be really late for a lot of you Asian traders. It's going to be in the middle of the night. But for the rest of us, we got to wait around for that data because we saw even today, the market did move on the ADP data. The ADP was a miss, and it was an ugly number. The dollar bounced back, but we saw some volatility, and the ISM just came in line pretty much. It was pretty much in line.
Yeah.
But the services number is going to be a mover, and I can't see it wrecking the market, Chris, unless the data is horrible. And the market's still looking for a print that's well above 51 for the services PMI to be 51.8. Actually, that's where expectations reside. We'd have to be below 50, which would be a contractionary number to see a really big response. Maybe that's it. What do you think about the ISM being the NFP proxy this week?
Yeah, I get your point. I think everyone. The fact is that people are looking at proxies and they are more sensitive to things like ADP and the services component of the employment or the employment subcomponent. Yeah, I think I get that. I think that's correct. And you can go into things like they might even be more sensitive to earnings. When they come out and some of the anecdotal evidence about what they're saying about hiring and various investments and capex and bits and pieces. That might be another situation, but. Look, I mean, if we're talking about the Fed's policy path, the ADP number, we know that's a terrible proxy for payrolls in terms of the net job creations. But the actual percentage or the changes that you see actually are relatively well correlated to payrolls. And so I think that's why the market reacted to this situation. The question here is that, if there is if the shutdown goes on for like 11, 15 days, which is kind of what most investment banks are saying is probably the likely path, and that's where the volatility markets are pricing normalized vol skews after that situation, after about 15 days. So that's the sort of duration that people are looking for before it starts going back. We should still get the payrolls number by the next Fed meeting on the 29th of October. So people are saying, well, it's very unlikely that the Fed are not going to know the actual payrolls number by the next Fed meeting. So the market's right now trying to price the risk and what that means. So we're going to get all these little proxies that come through, but the Fed should have the payrolls number by the next October number. And I think that's all that matters. And look, the fact is that everyone seems to think in the market at the moment that they have enough evidence to cut rates. I mean, we're pricing 100% probability of a rate cut in October, and about a 90% chance that they go again in December. So the market's saying, doesn't matter if we get a delay in this data, the Fed have enough evidence right now to cut again. Maybe they're wrong, but that's where they're saying, and we should get the payrolls before the next October print. So but we just lack any kind of patience in the market. We want to do stuff right here, right now. And if payrolls aren't going to come out for another 2 weeks, we'll just take whatever we can get, whether it's a Fed speaker, some sort of proxy in the economic data, and we'll work with that just to give us anything, to give us some sort of understanding of that pricing risk of payrolls. So, but the market at the moment is saying that an October rate cut is a done deal at this stage. Anyway, let's move on. Let's go into that. That's the setup. All right, let's go Tesla. I talked about it earlier, but you can see beautiful chart. Doesn't really matter what you think about the company. They sort of traded top end of the range, and since that point, you've had that breakout, and it hasn't really looked back. We saw a nice consolidation into 440, and again, it looks like it's taking this higher. The question now is that we've got delivery numbers which come out in the session ahead, and on the 30th of September, we obviously saw the 7,500 EV tax credit expiry coming through. So, people were rushing through purchasing Teslas so they could still get that tax credit attached to their purchase. And that's going to potentially show up in the delivery numbers in the session ahead. The market, the sort of consensus is that they're going to net off about 439,000 deliveries on the quarter, which would still be 5% below where they were this time last year. But after what they've seen in prior quarters, it looks like they're going in the right direction, which is exactly what they need, given they do have a pretty aging product range now, and a lot of the big stuff that was come through is obviously just staggered and not coming through. But I mean, for a lot of people who are technicians, you look at this right now and you say, does it really matter what they're doing? This is just a staggering, rip-roaring trend, and can this go up to $500? And that's the question. I mean, Elon Musk is now, I think, was worth about 500. I don't know.
Billion. 500 billion.
Yeah, I know, it's crazy money. But like I say, he's obviously loving the share price reaction, and but the question for a lot of people, momentum traders, you stay long the stock, but a lot of people have been buying anticipation that these delivery numbers are going to be very good and supported by the tax credits. The question then will be, once we get these numbers, will we get sell the fact playing through? As all these people have bought into this situation, actually get the realization of how it's going. I think they'd have to get a pretty breathtaking beat to support further buying in this. So, just be aware that we do get delivery numbers. A lot of people have been buying the stock because it has been ripping. It was up 33% in September, one of the best monthly gains. Can this kick higher? That's something we're going to be watching, but it has been a big supporting mechanism for US equity indices.
When somebody is worth 500 billion, all I have to say about that, more cuts. Give us more cuts. We need more Fed cuts. That's what we need, Chris.
Yeah, well, I think you're right.
All right. Hey, so this chart, I'm going to catch a few people off guard. I want to pull up silver. Chris, I couldn't even pull up the Pepperstone feed because it only went back to like 2001 or so. I had to pull up the ICE data, which happens to go back into the 70s to look at silver. So if you haven't realized it, silver is at those levels that are very big. 1980, beginning in 1980, Hunt Brothers drove the price of silver up to 48. You go to post GFC, I think it was 2011 or 2010, after all the quantitative easing, Silver made a run for that $50 level, $48 level, punched punched above it towards 50, and then we came back down. And at that time, we have the same arguments. If you weren't around during the post-Great Financial Crisis era, the Fed and all other central banks did massive amounts of quantitative easing and flooded the market with liquidity. Everybody thought silver was going to be $100. And I hear the same argument today about where silver is going to go from here. I don't disagree. I think it's a valid argument, but the point is we are up at levels we haven't seen since 1980. You have to think back what you were doing in 1980.
I was being born.
1980. I was just watching. I was watching cartoons and playing with GI Joes or something back then.
Yeah.
So, look, these are big levels. I'm not saying that we can't break out, but if you are long, you have to be very careful, very cautious about the levels we're at.
I think this is such a great chart because everyone loves a parabolic chart, and what goes up can quickly go down just as quickly. So I think this has just been a flow-driven momentum move. I mean, you've seen the inflows into ETFs, certainly in gold and, in the SLV and bits and pieces. But, the flows of late into the ETFs have been staggering. They've been a major driver of these moves. It's not just been, CTAs who have been buying into futures, and futures volumes have been increasing. But it's just been a momentum move. I put a video out earlier in the week saying, this is less about the why and about the who. Who's driving this money. It's just a momentum flow show. And, we've got another way I looked at this was how far price had moved away from the 50-day moving average. And we got to, I think for the last 5 years, we've only got about an 18% premium. We're now around 18-19%, and that is a level which is above, it's 2.5 standard deviations to the really long run average, which has contained the move. So there's just so many indicators that suggest to me that elastic band is really primed. I imagine a lot of people looking at it going, I want to get it into that shaded area because I want to be shorting the absolute bejesus out of this. So we'll see. I mean, it could, if you're trading with leverage, what you've got to understand is that you could be short. It could go up another 10%. And then you're ultimately right. Can your account handle that situation? So, timing, I don't want to call it a bubble because I don't think it is, but timing this idea is absolutely critical when you're trading on leverage. So just be careful that, you have these massive levels. Everyone's going to be looking to short into that. I can see everyone's just emotion wanting to shorten this, but it can easily go up another 10% from your entry, and that will hurt your account. Can you handle that, even if you'll prove right, 3 weeks later? So, it's just obviously the execution and managing that risk in that position is key. Anyway, let's go to the crude situation. Keep it ticking along because big levels being tested in crude markets as well now. I'm sure Trump would be loving this, although he's not really talking about crude as much as he used to. He's obviously got a government shutdown, which he needs to work on. But I think this has been driven off. We saw another failed breakout at the top end of that range. There's two of those now. Price rolled over. We were getting pretty excited. I didn't put a 200-day moving average on this because I should have done, because that's where it sold off once again. And, we were thinking maybe if we could see a strong close above the 200-day, that would get a few more sort of momentum, CTA guys involved, maybe a bit more short covering. But a lot of shorts did cover on that recent bounce up into $65. I think people are now getting short again. I don't think this has necessarily reflected the data. I think it's more a sort of a reflection on the supply issues because OPEC are talking about, further output increases going forward. We looked at the weekly inventory numbers. Gasoline's getting pummeled at the moment. Some of the distillates are getting smacked. The end products are coming down pretty hard, and obviously that's flowing back into the crude market, into the refined products. And what we're doing is testing the bottom end of this range. Now, will the bulls step up and defend this level? That's obviously something we're seeing. But inventories are rising, both in terms of crude, and certainly in gasoline and the final products. Big level there for any crude traders. For me, waiting for the daily close below that level could open up, a nice move back into sort of below $57. So big levels being tested here.
Yeah, it sure is. I think you could see a quick escalator down if we start breaking. So Good chart, Chris. I love the setup. Speaking of another setup, I want to talk about the euro sterling. You guys might remember this from 3 weeks ago. We were inside of that triangle, really close to the 50 DMA, and I was looking for a break long outside of the triangle. That did happen. It took like about a week or so before it broke out, but we're coming back and we're getting close to levels that I think are going to be tested. I actually believe, Chris, that the euro sterling is going to eventually break above 87.70, which is that big purple line. That's going to be a massive breakout, because if we break out above 87.70, you're talking about 89 pence, maybe 90 pence to get up to the upper end of its long-term range. And so I want to be long going into that 50 DMA or close to that green line. So I think this is a really good setup because you have very manageable risk. Obviously, if you broke below the secondary triangle line, the second green line that's uptrending, you break below that, that's where your risk is at. So I love this setup because, I still think it's going higher. Your risk is manageable, and if it breaks down, you can actually stop and reverse if you want to play it on the short side. So I still like buying this dip, and I liked it 3 weeks ago, and I like it again.
Yeah, nice one. Okay, well, with sterling in mind, I've got a play of the day, which might be of interest to you. Let's go to play of the day. Yeah, well, I was looking at a dollar yen upside last week. We got up to 150. I was pretty happy with that, and it's come smack back down. But today I'm looking at sterling yen. Needs a bit of work. We've sort of been consolidating. Looks like a bit of a distribution coming through. I don't particularly like the pound. I mean, it's sort of going along with all the other sort of risky kind of proxies coming through. The Bank of England, the rate cutting settings have obviously been pushed out into next year, the next one. But look, it's difficult to really like the yen. We're still sort of toying with the idea that the October meeting could be a live one. We're sort of 50-50 whether we get a rate hike playing through there. I don't necessarily think the LDP election is going to be overly volatile for the yen, but people are saying on balance there's probably a hawkish risks to the yen on the back of that. But look, I mean, I think this is a great setup, and I want to wait for a push through those lows, and I want to be getting short and ride that one down. I can't give you targets on this stage at the moment because I'm just sort of working this as we go into sort of lower time frames. But I think this is one that I'll be looking at when we get that break. It's going to give me the alert. I'm going to be looking to go short, and obviously just wait for the price to kick me out of that situation. But right now it's holding below the 5-day exponential moving average. Momentum seems to be building. We're getting some decent ranges on those 3 days down. I think it breaks the floor, and I think it's something that I want to capture when that finally does.
Look at us. Two ways of shorting sterling. There's multiple ways to skin this cat.
Many.
I like it, Chris. All right. My play of the day is going to be the dollar CAD, and I'm looking for further upside than dollar CAD. One thing about the Canadian currency, I believe the Canadian currency. I've been bearish Canada, and I love our Canadian listeners. I love my neighbors to the north, but I think the tariffs are going to have a bigger impact on Canada from a negative point of view. In the months ahead, and I think it's going to be reflected very much in the Canadian currency, which we're seeing right now. We broke out of a triangle. We're capped by the 200 DMA, but if we break above the 200 DMA, we break above the 38% retracement. I think this is going to be a bullish breakout. It's going to take us back up towards the low 140s, like 143 or so, which would be the 618 retracement, that red horizontal line that you see up there. Now, one thing that I do also want to mention about the Canadian currency, it has been very weak, even as the dollar has been weak. The Euro Canadian has been breaking out to new trend highs. The Canadian yen is breaking down, like, Westy's looking at pound yen or the guppy. Canadian yen's been breaking lower as well. The Canadian just looks weak. As the euro bounced from 116 and change to 117.75 the last couple of days, dollar Canadian barely even blinked. So if we see some dollar strength, the dollar CAD's got some upside, in my opinion.
Yeah, nice one. All right, well, it's consolidating, but I reckon if that breaks out to the top side, I reckon there's a nice little run to go through, and that could be one to put on the radar. I might try it myself. All right, Blake, thank you very much for watching. Oh, thank you for all your thoughts, should we say. Everyone at home, thank you for watching. Hit the like button if you like the show, and leave a comment and let me know what you're seeing in terms of the markets and how you're seeing the shutdown and all, the moving gold and Blake's setup on silver certainly is a big talking point at the moment. And we'll be back next week for more of the trade-off.